Seasoned Investor Part 15. Hello and welcome to today's video. In this video, we'll see how you can use the time segmentation strategy to invest for your retirement. We'll see how you can use this to secure your retirement income until eventually you say goodbye to this earth. And we'll also see how it is different from the traditional SWP plan that we know of, we generally use. Now, is time segmentation better or SWP is better? We now have two choices. So like and subscribe this channel right away so that this video reaches a lot of people.
So have you ever felt betrayed? Switches how you see things. Realize something needs change. 'Cause I know you got
Now consider you are into investing for a very long time and you have invested a lot of money. You have a big good corpus, PF, gratuity and so on and so forth, a retirement corpus, whatever it is, and now finally you are into your 58, 59 where you officially retire from your company. Now this lump sum money that you have at hand at this point of time, now time segmentation allows you to, or involves the process of matching up your investments to a point in time when you need it for your expenses. Now, since each asset will have a set maturity date, we can align these assets as per your need, as per your requirement in the future. So with this method, you can actually choose assets that would mature at different time frames in future, which then provides payouts to fund your expenses at every point in your life. Now let's see how time segmentation actually works. Now suppose you are into your late 50s or just 60 when you retire from your company and you invest in fixed income instruments that would mature at different stages in your life. Say from 60 to 65 for the next 5 years, you would probably need around 35,000-40,000 a month to run your family, to run your personal expenses. So this is how it works. Say suppose for year one, you invest an initial amount of 5 lakh rupees, which you would require the very next year, into a fixed income instrument that pays you around 6 to 7% annual return. So this amount, when it matures next year, would be somewhere around 535, 540, 530, 535. That's it. Now this 5.3 lakhs, you can break this down into 12 months and use the money for the complete next year. And now for the coming years, year number 2, 3, 4 and beyond, you have other instruments, other investments made into fixed income instruments. And you have those investments made for a 2-year lock-in, a 3-year lock-in, or whatever it is, or maybe a 4-year fixed income payout instrument. So if you have invested 5 lakhs now, or maybe 6 lakhs now, and you know this instrument would mature in 2 years' time, and it probably pays you 7% in returns. So that's 6.5 and 7 lakhs at the time of its maturity. You can utilize that money. Now I understand inflation eats down your money value, and that's the reason why you have a pile of money which matures at 6 or 7% for the next 2 years. Likewise, for year number 3, you have another instrument which pays you again maybe 7.5%, and it matures in 3 years from now. For your money requirement on the 4th year, on the 5th year, you have another requirement, you have another investment which pays you somewhere around 7.5%, and it matures after 4 years. For year number 5, you have another investment which pays you somewhere around 7.5 to 8%, and again it matures after 5 years. Now that's it. Don't go beyond that, because these are fixed income instruments. If you buy bonds, if you buy fixed income instruments beyond 4 years or 5 years, it doesn't help. The inflation actually devalues your final payout on the investment corpus. So beyond 4 years or beyond 5 years at the max, you might want to shift your investments from fixed income instruments to more liquid instruments, something like into liquid funds or maybe index funds, ETFs, something which pays you a little more but also takes into consideration the market volatility a bit. Not that much, but at least a bit. Maybe a direct index fund. Something in those lines. And when you go beyond 7-8 years, when you're planning to invest something for 7 or 8 years, definitely have something in the market. Give it the volatility, give it the exposure to equity. So that's how you balance it out. You give yourself a fixed income instrument for the first 3 or 4 years. And then, as the time horizon increases, for the next coming years, you shift your gears, shift your investments into more diverse and into the market. Slowly shifting your investment gears into other investment options as the time frame expands. Now see, you have given yourself a fixed 4 or 5 years of fixed income instruments before you shift your gears into other forms of investments. Now suppose you have a retirement corpus of a very small amount for easy calculation, say 10 lakhs, 20 lakhs, or maybe a crore. You divide this into year number 1, 2, 3, 4, and 5, 6, 7, and year number 20. That's how you segregate. For the first few years, 4 or 5 years, you select a particular amount. You know what's your requirement would be. Have that amount invested for the maturity year. Break your investments down. Have smaller chunks, have smaller investments which would mature in year number 1, year number 2, year 3, 4, 5 separately. This is known as laddering. Laddering your investments. Laddering or fixed income laddering. Now that you have confirmed your first 4 or 5 years of income into fixed income instruments, you expose the other investments into the market. Now what comes with that is volatility. What it does is, in good times, it will grow. In bad times, it will go down. Now, since you already have a 4-year buffer in front of you, if the market is still going good, sell off some of those equities and put it back into fixed income instrument. Probably by that time, you would have consumed your first year of expense. The first investment which was supposed to be maturing in year 1 might have just happened. You have consumed that money. Now you are left with just 2, 3 and year number 4. So 3 years of investment in front of you. And if the market is good, sell off some. Backfill those years into fixed income instruments. So right in front of you now, when you now have just 3 years of fixed income instrument in front of you and the market is going good, sell off some instrument, sell off some investment and put the money here. Fill up the next coming 2 years into fixed income instruments. Make it year 1, 2, 3, 4, 5 back once again. That's how you create your security. What if the market goes down? Fine. You still have 3 years in front of you, right? I understand the market is down. Let it be. It'll come back again. When it comes back again next year, maybe in 2 years, maybe in 3 years' time, you have the money. Push back. Sell off a major chunk and fill up your fixed income instrument brackets. Fill up the fixed income laddering. That's how you manage your money. That's how you do the fixed income laddering. So what is the advantage of laddering? What is the advantage of time segmentation? Now, what it does is, for the immediate future, for the next 2-3 years to come, it gives you a peace of mind because you have your money into fixed income instruments. Not all your money for the entire future, but for the immediate future, for the next 2, 3, 4, 5 years at the max, you have it in a fixed income instrument. You know that this is the money that you would get anyhow. Doesn't matter what the market does. Doesn't matter if it repeats a 2008 crash. Doesn't matter if it repeats the 2000 technology bubble. Doesn't matter what happens. You still have the money in front of you. It gives you a sound, secure, peaceful night's sleep. This is where it counters the SWP plan that we have. We know we have an SWP plan where we invest all our corpus into a particular mutual fund or whatever it is, or into the market or an index fund or whatever it is. And we set a percentage withdrawal. We say, okay, fine, we'll withdraw 4%, 3%, 2%, whatever, depending on your corpus, depending on how much money you have. You set a percentage of withdrawal every year. You say, fine, I'll withdraw 4% money. Let this mutual fund grow by 6, 7%, 10%, 12%, 15% every year, whatever it is, how, the way it grows. So the investment grows, say, suppose by 12, 15% every year. Inflation eats out 7 of them. And for the remaining 7 or 8% that I have at hand, I'll consume 4%, and the remaining 4%, it'll be pure growth for the portfolio. That's how an investor or an SWP investor thinks. But for those who are in the line of time segmentation, that's how they think. They do not believe in, maybe a 14-15% return. They cannot take the fluctuations. They cannot take the volatility of the market at that age, at the age of 65, 70. That's a big tension for them. They will not have their night's sleep, a peaceful sleep. For them, probably, this might be a very good idea to have, at least for the next coming 3-4 years, of their income into fixed income instruments. That's how these two investments differ. In SWP, no matter what you do, you ultimately have your corpus in a volatile market. All of your corpus in a volatile market. But in time segmentation, you have the initial 4 or 5 years of your corpus into fixed income instrument. It does not depend on volatility of the market. Doesn't matter what happens in the market. You will get the returns that you have calculated, that you know that you are going to get these amount of money. Beyond which, it is into the volatile market, but then it still gives you the time to rebalance and refill your fixed income instrument as you move on. Now you have these two choices: time segmentation, SWP. Which one you choose, it's your call. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.